Hello and welcome to Money Control. Well, we seem to start off this year on a rather cheerful note, but the markets are turning fairly volatile with some kind of nervousness finally setting in. It's hard to tell how this market will head going into this year, especially this quarter with, earnings kind of dominating the scene. But as we head into a very eventful year, a lot more is there that will determine the course of the market. Thus far, it seems like the market has been counting on a lot of positives in the bag. Fed rate cut by mid of this year, re-election of the present administration, all of this seem to be factored into the market. But this morning, in fact, yesterday at Davos, Geeta Gopinath, the first deputy managing director of IMF, warned that the market expectations of a rapid rate cut is premature as the battle against inflation is still not over. To talk about all this and what to expect in the upcoming union budget, I have with me Sonal Varma, Managing Director and Chief Economist for India and Asia ex-Japan at Nomura. Sonal, thank you so much for your time this morning.
Thank you.
First things first, GDP growth over the last 1 or 2 years has been absolutely remarkable. It is, always surprised on the positive side. It's been ahead of street expectations, ahead of estimates put out by the Finance Ministry and RBI. What has been the fundamental driver? What has really changed that we have not been able to anticipate this momentum as accurately as the economy itself has done? And do you see what will be the drivers going ahead to carry on this momentum, if that's your view?
Sure. I think, since the pandemic, we've been hit by surprises on and off again. And as you said, 2023 was another year of surprise with more resilient than expected growth globally, and particularly in the US, where most views, including ours, was of a recession. I think in terms of, therefore, the resilience of India growth, one is the strong global growth that we've had. I think that has, on aggregate, been a positive surprise. And second, for India, the front-loaded capex that the government has done, both at the center level as well as the front-loaded loan assistance given to states. I think the aggregate increase in capex has also been much stronger than expected. I think a third factor that has benefited India is the dramatic decline in commodity prices we saw in 2023 or FY24. So that has essentially meant that the terms of trade for India did turn positive. And you can see that in the macro numbers as well. For instance, the WPI inflation being negative, in a sense, is telling us that the input costs have come down quite rapidly, and therefore enabling firms to have a slightly higher, in fact, substantially higher profitability. So I think it's been a mix of global and domestic factors that have enabled this very strong momentum. Now, going forward, in terms of the forward-looking outlook for FY25 and for calendar 2024, our main view is it's going to be a year of strong start but weak finish. We do think the momentum continues to be quite strong in India as we've ended calendar 2023. In the first half, and particularly in the first quarter, which is the ongoing quarter, we think growth will remain relatively resilient. But we do see, or rather, it is our expectation that there will be a softening in the growth momentum in the back half of this calendar year. For one, we think the big push on public capex has been front-loaded, and as the election cycle gets ongoing, there'll be a moderation in public capex awarding activity, so that'll be more muted. Second, on the urban discretionary demand, which has been quite strong and partly driven by the drawdown in savings, still remains quite strong. But I think there've been some tightening in macroprudential norms in terms of lending on the consumer categories by the RBI, which we think at the margin will mean some moderation urban consumer discretionary demand. And third, it will depend on how global factors play out. Our house view is that the US recession is delayed but not denied. And in the second half of 2024, we are looking for US to slip into a mild recession. If that indeed plays out, as is our view, then there will, of course, be some spillovers on India. We are particularly thinking about the potential spillovers on the services side of the economy. So that's broadly our take. But net, I think on a relative basis, India still does look very strong as an economy.
Sure. You pretty much touched all the important points. You talked about front loading of capex, which I definitely want to come to, commodity prices, all of it more. But before that, I want to ask you specifically about, one component of the GDP, which has been the weakest part of the GDP, which is private consumption. How do you see this evolving over the course of the year? What is your prognosis? How do you see this piece moving forward?
That's right. As you said, I think the private consumption has been a disappointing aspect of the composition of India's growth recovery. Now, if we split up private consumption into urban versus rural, the rural side of consumption in particular is the one that's been quite weak. Our view on that is rural sort of derives income from both farming and non-farming activity, with the non-farming activity closely tied to jobs that are being created in construction, manufacturing, transportation, and sort of related sectors. And what we've seen is on the farming side, the cost of production has been relatively high compared to the output or the returns that farmers have got. And on the non-farming side, our view is the job creation is probably not happening at the right pace. So, for instance, even when we look at rural wages, on an inflation-adjusted basis, real rural wages have actually been quite tame. And typically, if you look at the distribution of savings between urban and rural consumers, the savings rate usually are lower at the rural end of consumers. So while urban consumers have higher savings, which they've drawn down to partly, consume more, that excess savings or savings is not as much of a buffer for rural India. So I think it's a mix of all of these factors, but net, it's essentially been an environment where terms of trade for rural economy have been under pressure. Now, in terms of where we go from here, the inflation side of India over the next 12 months, we think will gradually improve. So over the last 12 months, while we've seen core inflation come down, food inflation, which actually has a higher weight in rural expenditure, has been volatile, but mostly on the higher side. So over the last 12 months, on average, we've seen inflation closer to 5.5%, if not a shade higher. Compare that to the next 12 months. If we don't get any major shocks around food prices, then our view is on average inflation in 2024 as well as in FY25 should be closer to 4.5%, driven both by sustained moderation in core inflation as well as a moderation in food inflation. So from a real income perspective, some of the squeeze that consumers in the low and middle income bucket were facing because of higher inflation, we think that should be less of a headwind over the next 1 year. And to that extent, consumption demand from those categories should be at the margin better. For rural consumer, as I mentioned, there's some tightening on the lending side on credit disbursement, particularly on the unsecured side of credit lending, and jobs in the IT and related space has come off. So we would think that there should be some normalization in fact, urban demand. So some rebalancing of consumer demand between rural and urban over the next 12 months. On aggregate, consumer demand over the next 12 months should be flat to marginally lower compared to the previous 12 months, but broadly stable, I would say, not expecting a major reacceleration in consumer demand at this stage.
Okay. And do you expect any government intervention in this regard?
I mean, from the government's standpoint, I think the strategy has been to look for more durable ways to get consumption going. In the sense that the public capex essentially crowding in private investment, that creating more jobs, and that essentially creating more demand and more consumption. So I think direct intervention from the government, if we are thinking about any kind of tax tweaks, etc., we don't think will be a major strategy. And typically, these also don't work because unless there is certainty of income profile, any such boost typically ends up getting saved rather than consumed. So we are not expecting any major government intervention at this stage. There are, of course, particular segments of the population that the government wants to focus on in terms of farmers, for instance, and those specific targeted intervention could come in, but not broad-based consumer focus.
Okay, so that's not, according to you, that will not be on the agenda for at least in this budget.
Not in this specific budget, that's right.
Okay. The second piece I wanted to talk about is merchant exports, which again has been a weak spot. And I've heard you say earlier that this is part of this, global slowdown in goods that has happened over the last 1 year or so. Explain to us, what is this phenomena really about, and when do we see a rebound? Especially as we are also, thinking about, possible. You said that clearly U.S. recession is on card. It's not like it's delayed but not denied. In that context, how does our merchant exports really look?
Yeah, so we are seeing some signs of, I would say, bottoming out in the export cycle more broadly, actually, globally in Asia as well as for India. Essentially, the post-pandemic recovery saw the goods sector basically recover much stronger initially compared to services side of the economy. And of course, because of the supply chain constraints, we had demand exceed supply. So we did see significant inventory issues, as a result of which companies across a number of sectors, including semiconductors, ended up doing double, triple ordering. So over the last 18 months, we've seen sort of normalization of demand as services picked up and people moved demand from goods to services after the reopening. So we went from a period of excess demand to a period of excess supply. And we've been, in a number of sectors, a period of inventory correction cycle, which has weighed on goods demand globally. I think the other aspect which has been important is inflation. Very high inflation in the developed world has depressed demand for goods in particular, and that has also weighed on the global trade cycle. So while, for instance, the US economy has been very resilient and we've avoided a recession so far, the goods cycle actually has gone through sort of a recessionary conditions, I would say, and that has weighed on exports for a number of big exporting countries, including India. So what we are seeing right now is that this inventory cycle has played out. Inventories are generally more lean across a number of sectors. And of course, inflation is also coming down in developed economies. So real incomes are picking up, and you're seeing some stabilization in goods demand in the advanced economies, which is the reason we think that there are early signs that the goods cycle is bottoming out. So for India also, that should mean that going forward, we've sort of moving from a period of deep contraction in exports to a period where exports are sort of turning in the black right now, and potentially could move into the positive territory going forward. There are two risks we, of course, need to monitor. One is the Red Sea disruptions that are going on the shipping side. The economic impact of this really depends on whether this is a short-term disruption or a more prolonged disruption. But this could cause some short-term hiccups on the trade side. And second, of course, is the broad strength of demand in advanced economies. If the US does slip into a recession in the second half, as is Nomura's house view, then that could mean that this export cycle ends up being more short-lived. So we need to see how that plays out. As of now, as things stand, yes, the goods cycle is bottoming out, which should be positive. A big part of the turnaround, though, is being driven by semiconductors, and therefore will benefit some of the more tech exporting countries in Northeast Asia. But at the margin, I think India should benefit as well on that.
Okay, so you're saying merchant exports, we could easily say that is bottoming out, subject to the fact that a US recession does not happen. But if it were to happen, then you have to wait and watch. It could get worse also from here on. Is that correct?
It may not get worse. I don't think it'll get worse because things are already quite bad there. But the recovery, the early green shoots we are seeing right now could wither away. And so we could see things improve and then drop again. At this stage, we don't think things will get as bad as they were back in 2023.
Right. And Sonal, if you look at the composition of growth, domestically, I mean, real estate has been one piece that has shown rapid growth over the last 1 year. Do you see this cycle continuing, and what are the triggers?
Our view is this cycle could continue because if you look at the last decade, the real estate sector has gone through its own, what we would call more of a time correction rather than a price correction because of various issues, including the supply side changes that have happened on the real estate regulatory side, or the excess project launches that had happened, which led to a lot of inventories that these developers were sitting on, interest rate cycle that were tightened quite aggressively on the real interest rate side after 2014. So a whole host of things that have happened which has weighed on the real estate sector. We have dealt with it. So from the builders' side in terms of their balance sheet and situation, as well as from the consumer side, where affordability today is much better compared to what it was 7-8 years back. So I think we are actually fundamentally in a stronger position on the real estate side. Now, the interest rate sensitivity, of course, is also quite important. The nominal repo rate at 6.5%, and of course, mortgage loans, let's say, depending on the bank, but let's say around 9.5%. I think are levels where we could still see steady demand for real estate. Perhaps not as strong as what we've seen back in 21, 22 and parts of 2023. So we should see some moderation in housing demand, given interest costs have moved up over the last 12 months. But I think these interest rates are at levels which can easily be absorbed by consumers, particularly if the job market and their own income growth remains reasonably strong. So I think it's in that backdrop that we have to assess the outlook for the real estate sector. And I think fundamentally we do stand in a good position there.
Okay. So then if we just took a narrow view of what is happening in the numbers that we see in the listed space, it's very clear that it is only the luxury segment that has been doing well. Somehow volume doesn't seem to be coming in the affordable, housing segment. Do you see triggers in place for that segment? Because unless that segment comes up, and participates in this growth, the cycle to move forward may just become difficult.
The focus is going to be again on the low end side of housing. So more allocations under that could come through from the government's side. So at the margin, that could be a trigger. we don't think this will materially turn the cycle, immediately. So it's at the margin a positive, but other than that, we're not expecting anything on the affordable housing side.
Okay. Coming to the fiscal deficit, first of all, what is your projection for the year? And before that, actually, you can tell us the projection for the year. And do you see any fiscal pressures mounting going into this year?
Right. So FY24, lots of moving parts, some positive, some negative. On net, we think the government will meet the 5.9% fiscal deficit target. There's been some disappointment on disinvestment. The expenditure numbers on the revenue expenditure side are on the higher side, but direct tax collections have also been quite strong. So we think that should be able to offset some of the negatives, including the lower normal GDP growth we have seen in FY24, which basically sets us up for FY25. This, of course, being an interim budget, but also importantly, the pre-election budget. We do think that the big focus for the government in this budget will be on the specific, electoral categories. So, we're looking for more allocations to come through on rural, on agriculture, for farmers, for women, for youth, as I mentioned, low-cost housing. So some of these specific segments could get more allocation. Capital expenditure has already been ramped up quite significantly over the last 2-3 years. We do think that the momentum on capex will be maintained in FY25, but at a slower pace compared to the last 3 years. And therefore, on net, we think FY25 fiscal deficit target should be brought down to around 5.3% of GDP, so about a 60-odd basis point in terms of consolidation, with the objective to get to the medium-term target of 4.5% in FY26, or at least as close to it as possible.
Okay, but do you expect an increase in the public spending number?
Yeah, of course, the aggregate expenditure is going to go up. So both on the revenue expenditure side, which is allocation
capital expenditure. Capital expenditure, do you expect it to go up, and by how much?
Yeah, we do expect capex to go up. So for FY25, we're building in roughly around 15% in terms of increase. Compared to FY24, where it was set at over 30%. So the 20-30% kind of increase we have seen in the last 2-3 years, we don't think it's going to be as high as that, but we are still building in around a 15% increase.
And any change in the the three main subsidies, food, fertilizer, and oil? Do you see any significant changes there?
There isn't a need to be changing anything there in this particular budget. I mean, the allocations that typically go under the food subsidy, under fertilizer, which is a big, that's primarily a function also of how global fertilizer prices play out. And these two are the big subsidy expenses. Now the oil subsidy quantum is not really that much. So as far as food and fertilizer subsidies are concerned, our view is they will remain largely around FY24 levels, maybe marginally higher. But I think at this stage, unless there's a big change in fertilizer prices, for instance, globally, it's very hard also to presume that this will go up, materially.
Okay. One final question on interest rates. What is your house view on when Fed will start to cut rates, and will RBI follow, or could it even precede?
On the Fed, our view is the first cut will come through in June. So we don't think it'll come as soon as March, which is now partially priced in by the markets. And for the full year 2024, we're building in around 100 basis point in cuts. So again, less than what currently is priced in. Primarily because given the inflation challenge the Fed has basically faced in the last few years, we do think they will wait to ensure inflation is durably down before they start on the easing cycle. For the RBI, we don't think the monetary policy is that closely linked to the Fed, so it's more determined by domestic factors. On that, I think the biggest positive for India is the moderation in core inflation that we have seen, 3.8% in December. And for the next 12 months, we do think core inflation will stay below 4% as well. And the headline inflation also averaging around 4.5%. So if you're right on that, and if indeed growth moderates in the back half of 2024, we think that will be the trigger for the RBI to move, because implicitly what that means is that at 6.5%, the real policy rates will be close to 200 basis point, which is on the more restrictive side. So for us, the RBI, will sequence the monetary policy exit, starting with the change in stance to neutral, which we think could come through as early as April, followed by actual repo rate cuts, which we are currently building in from August onwards. And for FY25, cumulatively, we have 100 basis point in cuts, so that should take the repo rate down to 5.5%.
Sure. One really last question. Any other big announcements that you expect in this budget?
I think the main, I think takeaway from this budget is going to be how the government balances, pre-election pressures versus fiscal consolidation. So all this increase in allocation towards low-cost housing, farmers, women, youth, etc., is obviously going to come at a cost. Plus, we need to maintain the pace on public capex because private capex hasn't picked up. And in that environment, we still need to consolidate our fiscal finances. So I think the big announcement in this budget essentially is likely to be more focused on around pre-election. But I think from a market standpoint, it's really the government's ability to balance that while ensuring fiscal consolidation, which should essentially be the main takeaway in our view.
All right. Thank you so much, Sonal. It was a pleasure talking to you.
Thank you.